Hey guys, David Robinson here. Welcome to the apartment investing journey. I'm excited about our guest today. Lennon Lee is a guy that I've been following and watching, and he's done some really impressive things in the multifamily space, and I'm excited to have him on the show today. A little bit about Lennon. He is the founder and principal at BLD Capital Group, a boutique investment firm focused exclusively in the multifamily space. Alongside his investment partners and investors, he has been involved in the acquisition of over 1,500 units of multifamily with an approximate market value of about $150 million. A full-time investor based in Miami, Florida. He's also the founder of the Multifamily Investing Club, a knowledge sharing and networking community that provides an educational and relationship building platform for local multifamily real estate investors. He's also the co-host of Se Habla Real Estate. You can tell that I don't speak Spanish. The first ever real estate investing podcast in Spanish, which I think is really cool. And he's also the author of the Passive Multifamily Real Estate Investing ebook, which I want to talk about a little bit later. He was born and raised in Venezuela and moved to the U.S. in 2010. So with that said, Lennon, welcome to the show, man.
Cool, man. Thank you for having me.
Yeah, my pleasure.
Yeah, definitely. Looking forward to it.
Well, as I do with all my guests, I'd like to hear about your journey into the multifamily space specifically. And so if you can, let's back up all the way and tell us your story. You were born and then what?
Yeah, I was born in Venezuela. Yeah, in a small little town in Venezuela. It's not Minnesota. A lot of people try to but yeah, that's in Latin America. Moved to the United States in 2010. Before moving, I went to school for telecommunications engineering. So I did that and then immediately moved to the United States to pursue a master's here in FIU in engineering management. Around that same time that I moved, maybe like a year before we moved as a family, we bought a small portfolio of properties, condos and single family here in Miami. So when I moved to the United States, I started managing that portfolio for my family for a little while, well, for a few years actually, until we started moving into the commercial space. Part of the reason, well, you know, on my professional side, I was going to school and then I went to work for a startup company. I was doing like logistics and supply chain management for them for a couple of years. I realized that, well, definitely wasn't for me. I was not enjoying it. I was doing the real estate thing for my family and I was enjoying it. So eventually I got my realtor license because I was going to sell some of those properties. So I figured I might as well get my license, you know, and you know, save the commission there. The idea of moving that portfolio that we already had came from the fact that my family, mom, dad, sister, they moved to Panama and they figured, well, what are we getting from that money that we have there? You know, like the cash flow is not good. I mean, it's not bad, but it was like the actual return on equity. We bought all these properties cash. So at the beginning, it was great because we bought at the bottom of the market, and the rents were nice. Later on, around 2015 or so, the return on equity wasn't there anymore. Cash flow wasn't as exciting. So we started looking for a vehicle where we wanted to, you know, have, first of all, capital preservation. That was the first thing that, you know, we talked as a family, hey, let's make sure we don't lose the money. Mom and dad, we already did what we were going to do, so you better take care of it. So that was the first thing. And then focus on something that, okay, obviously allows us to live off of that, you know, from the cash flow, but then also if we can grow it as we go, then, you know, that's a plus. I figured that, you know, I started studying and looking for options. We knew we wanted to do real estate. My family, you know, my grandfather, who I never met, he always told my mom, hey, the goal is to live off the rent, whatever that meant at the time, right? He probably meant retail things or whatever. But we always pursue real estate. My mom and my dad, they developed a few townhouses down there in Venezuela when we were living there. as well. So, we have a little bit of a background in real estate. We wanted to stay in real estate. And we figured, well, commercial real estate started making a lot of sense to me because of the way that it's valued, so it's more like a business, and that got me excited. I wanted to do commercial real estate, and then I figured, well, commercial real estate, okay, but then what do we do? Where do we park the money? What's the exact vehicle? Well, first of all, multifamily, and we can talk about the trends, and I'm sure you've had a lot of guests here that have discussed a lot of the benefits of multifamily and historically how it's been performing. So that was part of the big reason. But also the specific vehicle, which is real estate syndications, where we could come in as a family and be totally passive. That's what we were looking for at the end of the day. Passive income, where we could deploy our capital little by little, diversify across markets with different companies that we can build relationships with. And ultimately, that's what we ended up doing. And we started investing in 2016 with an operator out of New York, but the property was in Texas.
So I'm curious how you found the concept of syndications, and where did that idea of passively investing in someone else's large commercial multifamily deal first hit you? Where did you come in contact with that concept?
It started, I think, in bigger pockets. I became a member of the community, and I started reading the forums, and I think that was the first time that I kind of read about it. And then I started seeing some people talk about it, and I ended up listening to a few podcasts at the beginning. Joe Fairless, and I think Michael Blanc as well were one of the first ones that I started listening to, and also the Bigger Pockets podcast as well. So I think that's when it hit me, and I started to like it, and I like what I was hearing, and it made a lot of sense. It ticked all the boxes that we were looking for.
And so you had this portfolio of, I believe, single family. Did you say it was single family rental properties?
Condos and single family.
Okay. And what market were those in?
Miami.
Okay.
Yeah.
And so you had this portfolio, and you knew that you wanted to make this transition into commercial. You started to learn more about multifamily, and then also learned about the concept of syndication and passively investing. Yeah. If you can, I think there's a lot of people that are listening to this podcast and that are in this space that only look at multifamily as an active investor. They don't really understand, or maybe they haven't been exposed to the concept of passively investing in someone else's deal as a limited partner. Maybe share your experience and how obviously you learned about this concept through the podcast and through Bigger Pockets, but how did you actually execute on repositioning the equity that you had in your single family rental portfolio and into syndications?
Yeah, that's a great question. This is a lot of the conversations that I have typically with my investors. It's a lot of this same concept of, okay, but how does it work, right? And honestly, it took a lot of education first before pulling the trigger. And let me just put it this way. When we started looking for that vehicle, we as a family, we wanted to be 100% passive. The reason was I was managing this portfolio, and I had to deal with tenants. I had to deal with toilets and everything. I was doing the property management for these small properties and for the single families. And at the end of the day, that wasn't what I wanted to do. I didn't want to be a property manager. It's not like I didn't want to be active, because that's what I ended up being. Right now, I'm an active investor as well. But the whole philosophy of the company and the way we approach our investment strategy is with the eyes of the passive investor. So it was fairly simple, but not easy, right? So the way I did it was initially being very active in the community of Bigger Pockets and listening to podcasts. And I bought all the books that I could find on multifamily investing, and then syndications and articles and everything. So a lot of education for quite a few months. That in combination with building active relationships with people that were doing the active investing and raising capital from passive investors like me and my family. So I started building relationship with a few of them to see, well, who am I going to end up investing with? And at the same time, I became a member of a mentorship group. Okay, so I did all those three things actively to, well, first of all, develop my education. Second of all, build a relationship with the operator that I wanted to invest with first, and a personal relationship. That is, to me, that's very, very important. And then the other part is to have like a higher level education other than just reading articles and listening to podcasts. Actually learning from someone that's doing what I wanted to do at a high level. So I started combining all of that. It took me probably, close to a year to start, since day one, basically until the first investment that we made as a limited partner. And that's the way I approached it. I mean, I think I mentioned the personal relationship side. It's very, very important because the way I see it, I'm gonna have a criteria or a personality that is gonna be a potential good fit with, let's say, 3 different operators or syndicators or sponsors or GPs. We have a lot of names for them. And they're gonna be a good fit. And if I check their backgrounds, they're probably gonna be okay. If I check their track record, then it's gonna be fine. If I ask for referrals, maybe I'm gonna get some good referrals. And at the end of the day, I'm gonna end up with a few options. Okay, who do I invest with at the end of the day? I think it boils down to the personal relationship that you build with these guys and the understanding of, first of all, if it's a good fit in terms of personality, the way they talk to you, the way you can talk to them or communicate, and that relationship, but then also understanding the integrity and the character of these guys. They might not be a bad guy, but they might not be a good fit for you, So that's the way I approached it. And ultimately, I bought a plane ticket. I met these guys in person, build that relationship, and and then we pulled the trigger on the first deal that they had after that, few meetings actually.
That's great. Thank you for going into some detail about that process. I'm curious. So have you transitioned completely out of your single family and condo portfolio into passive investing, into syndication, multifamily syndication?
Yes. Basically, yeah. We still have some property that we bought in Panama because my family is there. So we bought a couple of properties there that we might end up selling and then bringing the money back here to the U.S. to deploy it on some other deals. But so far, yes.
And what was the biggest, because I think there's a lot of people that are sort of in this space. Maybe they don't have as large of a portfolio as your family did. Maybe they have a couple single family rental properties, maybe a small multi, like a duplex or something like that. And they recognize the same challenge that you faced, which was they're a landlord and they really don't want to be a landlord. They don't want to be a property manager. They know that they want to be in real estate. They have some equity tied up in these single family rental properties or small multis. They want to scale a little bit. What were the biggest challenges that you faced in making that transition, in liquidating or repositioning the equity that you had in the single family portfolio into the syndications? Were there any challenges?
I mean, yeah, definitely. I mean, I would say that the one thing would be the timing. It wasn't perfect every time, I mean, for the first deal, we happened to have sold one of the properties and we had some cash, and as soon as we saw the first deal that we liked and I analyzed and I ran the numbers, the whole thing, we invested on that one. But then on the next ones, it was a little bit of a game of, okay, we had to sell the properties. Do we sell them and like actually try to do a 1031 into another single family, just to keep the deal, or do we take a loss, take a hit on the taxes and then still redeploy it? Well, that's I guess there's no right answer for that, but for us, it made sense to take a hit on the next property that we sold and then redeploy that money into the next deal. I found that one deal that I really wanted to do, we didn't have the capital, we didn't have the cash at that point, so we had to pass, obviously. So that was, I guess, a little bit of a challenge because ultimately, well, you just need to be patient. And that was a little bit of a learning experience for the future where, as of right now, as an active operator and syndicator myself, it's it's a lesson learned where patience, it's really the asset now, at this point in the cycle, even more so.
Yeah, I appreciate that. I want to dive a little bit into your existing business as it is today. You spend a lot of time educating people in this space. You also are, as you've mentioned, you're an active operator yourself. How much time would you say you devote to doing your own deals versus raising capital for someone else's deals? Well, yeah, I'm curious about the balance in your business life right now,
Right.
and how you manage that. So let's start there, and then I'll ask my follow-up question.
Yeah, definitely. Yeah, this is one of my favorite questions because I always like to talk about how I structure the business and why I'm doing it this way. Like I think I mentioned before we started recording, that everything that we do, it's from the passive investor perspective first. And that's everything that I do. I always tell people I'm an LP, I'm a passive investor first before anything else. So the way my business is structured right now is, I like to call it, I'm building a curated network of some of the top operators, syndicators in the country in different markets. So I can deploy my family's capital into that network and diversify within the asset class that I like and that I think has a lot of potential long term, which is multifamily, right? But then how do you, okay, we like to say we're super focused in multifamily, but then how do we, diversify within that same focused approach? So it's that's the way I size. So if that's going to be of value for my family and for me as an investor, I was sure that there were other people that was going to find value in the network that I was building, because, well, I'm doing it full time. I'm, I throw everything in the kitchen to devote myself really to learn about the strategy, learn about the business, being active, build relationships, the whole 9 yards. And I know there's families and people that they just can't do that. They don't have the time. Maybe they have a business, they're a lawyer, whatever they are. So that people find, they find value in what I'm doing. So that made a lot of sense. So if I can do that and grow in the industry as a limited partner, yes. But then if I can bring value into the active side of these deals by partnering up with the operators that I'm investing with anyway, I can maximize my LP investment, right? Because if I'm a limited partner investor, but then I'm also a general partner in the deal, well, I'm maximizing my LP investment. That's the way I see it at the end of the day. Yes, I'm doing active stuff now. It's not all passive, okay? Well, but still, I had the time. I didn't have a job at the end of the day, so I started building a company under that concept. Right now, it was just a matter of, I guess, of time while we partner up with a few operators on a different deals in Texas. Then I started seeing the opportunity, which is just natural, to do my own deals. I had a network of people that I could, raise capital from. I already had connections, broker connections, and we started looking at a market specifically in Jacksonville. Me and a partner, a couple partners actually, and we did a deal. So the way 138 unit deal. That is, that we closed that one in February 2019. The way I see the whole big picture is I'm still building a network of what I like to say the best operators and syndicators in the country that are a good fit for me, that is. And my company is just another operator within that network. That's the way I see it. So, yeah.
I love it. I love that you have focused your business mindset from the perspective of the limited partner.
Yeah.
And I think that aligns you with your investors, obviously moving forward and in the past. And I think that your investors can trust in what you're doing, the deals that you're looking at, the operators that you're partnering with, because you look at it from that limited partner perspective, that passive investor perspective. And that would ultimately, it comes down to trusting the individual. And you already touched on this, but it's that personal relationship you have with these people. But sometimes as a limited partner, you don't have the luxury of getting to know these operators as on a personal level as you would like. Right. And so having a connection with you, someone that they can trust, that they're building a long-term relationship with, but that can also put them into different markets and different opportunities that they may not be exposed to, is invaluable.
Yeah, definitely.
Love it.
That's the whole idea. I mean, and the conversation, it's totally different, right? Like I said, like I mentioned before, I'm doing this for myself, for my family, because I have to, because I think it makes sense for us. So if you want to take advantage of it, let's join forces and go into these deals. I'm investing in the deal anyway. You know, I'm trying to invest on every deal that I bring investors to, and that I'm a general partner on. I'm trying to invest on every one of those deals as a limited partner. So that's, the conversation is totally different when you approach it that way, you know. So people see that and they understand it, and you know they see value in it. So that's kind of the way we look at it.
That's great. That's great. Well, I want to dive into this 138 unit in Jacksonville, but I did want to touch base real quick on your efforts with Se Habla Real Estate. That's your podcast that's specific to the Spanish community. Tell me about that. I'm interested in that endeavor and what you're trying to accomplish there.
The reason I started that podcast or that project, because that's the way I see it, it's very close to the same reason that I started the investment company. When we moved to the United States, the only option that we thought we had in terms of investing was, okay, which is what everyone was doing. Well, find the next realtor that you like, and let them know that you want to invest, and have them, well, basically bring you deals. Deals meaning a condo in the best part of Miami, which is like Brickell downtown area, and you buy that, and that's it. That's your real estate investment. We didn't really know we could be part owners and join forces with other savvy and experienced operators and investors to become a owner of an apartment complex, right? Which was, we just didn't know that existed. So part of the reason I started the company was to offer Latin American families like mine the education, obviously, but then the opportunity to join forces with us and invest alongside us. And then the Spanish podcast, it's just like a complement to that idea, which allows us, and that's me and a partner, and it allows us to share. It's not specific content about multifamily and syndications or anything. It's real estate investing in general. So it's how are people making money in the United States through real estate, whatever that looks like: flipping, wholesaling, multifamily, private lending, you name it. We try to have hosts and topics around everything real estate related. So that's kind of it.
I love it. Yeah, that's great. And that's a great little niche to focus on. You're serving people that you obviously have a personal connection with, that you have been in their shoes before, maybe didn't know where to go, how to go about it. And I think that's great that you're educating them. Okay, cool. I did want to touch base about the passive multifamily real estate investing ebook that you have. I know that you produce a lot of content. Tell me a little bit about that ebook. Like, what's that all about?
Yeah, that's a fun little short book that I wrote. Honestly, the idea was to have something that was very simple and very graphic, and people could understand of how this whole syndication thing works, and how do we actually go into a deal, buy an apartment complexes, and add value to it. That's the bulk of it. It's really more focused on, okay, how does the investment process work in terms of the business plan execution and adding value to this multifamily deals. But then we also talk about the actual syndication process, who can invest, and then at the beginning it's a lot of comparing like passive income versus portfolio income versus active income. Which is, obviously, I guess at the core of everything, we're all looking to have passive income. So yeah, it's I take like a sample. Well, it's not even a sample. It's like an imaginary property that I created with fake numbers. Very, very simplified, but the concept of the whole thing is very easy to understand on that book. So
that's great.
Idea, yeah.
So someone that's just starting to learn about this concept of syndication and investing passively in larger commercial multifamily deals could go to this book and get sort of a condensed, sort of simplified version of how the whole process works.
Yeah, definitely.
Cool. All right. Well, let's dive into this 138 unit in Jacksonville, Florida. Are you okay to dive into that now?
100%.
Let's do it. So to start off, tell us how you sourced the deal. Where did you find it? How did you get in front of it?
Yeah, great question. That's very straightforward. We found it through a broker. It was on the market. It wasn't, nothing sexy, off market, mom and pop operator, nothing like that. It was straight up, like the owner were actually like a big investment firm. They don't do syndication per se, but big investment firm out of New York, if I'm not mistaken. And it was on the market. We had a good relationship with the broker, the listing broker. We had put a lot of intention and efforts towards building those relationships previous to us obviously getting the deal. And we offered in, and the broker put in a good word about our group to the seller, and we ended up getting it. Yeah.
How critical was the relationship with the broker and you actually getting the deal?
Very, very critical. Like it was very important that we had that relationship. If not, I don't think we would have gotten the deal. Just to be honest, I think the broker really wanted us to have the deal awarded to us. So
gotcha.
And that's because of that relationship. Yeah.
Cool. And how far in advance had you started building a relationship with that broker?
So we, let me see, we got the deal awarded to us around, like October, probably November. Yeah, in November last year. And the first time we went to Jacksonville to, start our research and let's start looking at the market and building relationships was probably 6 to 8 months before that.
Cool.
So that's how long it took.
That's great.
Yeah.
Good for you. Okay. So broker brings you the deal. You put in the offer. That relationship really pays dividends. You get awarded the deal. How did you go? How was the acquisition structured? What was the financing and the deal structure, if you don't mind diving into that?
Yeah, definitely. So the deal structure for our investors, really, it was very typical syndication where we offered an 8% pref, preferred returns to the investors, and a 70-30 split after that pref. And we threw in a little it's not necessarily, you could probably call it a waterfall, but basically after we hit 2 times equity multiple or 100% returns for the investors, or actually if we hit that number, then we go 50-50 between the GP and the LP.
Cool.
Yeah, so that's the typical structure.
What about the debt structure?
Yeah, 80% debt on that deal, including 100% financing of the renovation budget. Yeah,
Right.
so it's a bridge loan. It's a three-year bridge plus one, which is so yeah, basically 2 1-year extension options. 80% leverage. The deal makes a lot of sense. Like, we're typically not gonna do bridge loans, but if the deal makes sense, we're not gonna shy away from it. I know a lot of people are all for long-term fixed rate debt. We're also believers on that type of debt when it makes sense, which is probably the majority of the time because of the criteria that we have. But for this one, it made a lot of sense to have this type of debt. We bought a cap on the interest rate, which cost us like $30,000, and I can't quite remember the specifics, but it's probably, I would say, like 150 to 200 basis points above where we are right now.
Gotcha.
That's roughly.
Okay. I should have asked earlier, but can you just describe the building and the property a little bit?
1974 property. It's located in a nice little pocket of Jacksonville called San Jose. Well, it's actually San Jose and Lakewood. It's 138 units. It's definitely a Class C property that we're trying to reposition to a more of a Class B minus property. The area is very nice. The whole business plan, or the approach, and what made us different in the eyes of the broker, and then obviously in the eyes of the seller, was that this property is located actually like in the intersection of 3 little pockets, which is San Jose, I can't remember the other one, and Lakewood. And the property was called San Jose Apartments before, and we rebranded it to Lakewood Oaks. Lakewood, out of the 3 areas where, in the intersection, Lakewood is the more affluent area. So it was more like a marketing play. And there's a property there's a couple of properties actually more towards the west side, which is the Lakewood neighborhood, called the whatever Parks at Lakewood, or whatever. And we figured, well, if we can rebrand the property, give it the Lakewood name, because technically we are in Lakewood, we can go ahead and provide a product that is definitely not going to be at the same level that the Lakewood properties. We're more like Class B plus, maybe A minus properties, but we can have a good product, be way below them, still be in Lakewood, and differentiate ourselves from the actual comps that everyone else is using in the San Jose submarket. So that's kind of the way we approached it, and it paid off. And right now, so far it's doing okay. We definitely can't complain. I wouldn't say a home run deal by any means. It's very, very solid single so far, and we're very happy about it.
That's great to hear. Can you tell us a little bit about you talked about the marketing plan and that part of the business plan, as far as repositioning it from a marketing perspective and a market perspective. What was your plan as far as any capital, any CapEx?
Yep, $1 million total, out of which 600 was for the more like 650 or so for the interior renovations, and the rest for the exterior. We went in. We pretty much finished with the exterior renovations. We did we installed a new dog park. They didn't even have one. A summer kitchen, which is like an outdoor barbecue grilling area. All new pool furniture. We repainted the whole property on the exterior. We gave it a nice pop of color, like gray and like new, very modern colors. We renovated the leasing office. We did that. What else did we do? We're taking care of, well, all the woodwork, all the wood repairs and everything before actually painting the property. We are doing a new monument sign. That one's to be installed really soon. And the parking lot, it's being basically repainted and, you know, making it look nice. And we're doing some other stuff on the exterior. And yeah, that's probably it. And then on the interior, it's all kind of basic, you know, new flooring, like faux wood flooring, black appliances, new countertops on the kitchen, actually resurfaced countertops, actually, new lighting fixtures across the board, two-tone paint, yeah, lighting fixtures. Yeah, that's probably it. And, you know, a few other things here and there, but that was kind of the plan.
And of the 138 units, are you planning on turning all the units, or have any of them been renovated or updated before you acquired the property?
Yeah, not really, not to the standard that we are doing them. So we could say that if we wanted to do the 100% of the units, we could do a full 100% renovation, but we're actually aiming to do 75%, to leave some meat on the bone for the next buyer. If it makes sense, we might even cut it a little bit shorter than that, or, you know, take it to a full 100%. We're gonna see, but that's kind of the plan.
Great. And that was a recent acquisition, right? Just earlier this year. Is that correct?
Yep. February 2019.
Great. And do you see yourself refinancing and holding or exiting?
That's part of the reason why we used the financing that we did, was to allow us some flexibility to actually either refi and go longer term debt if it makes sense, or just get out of the deal without a huge prepayment penalty. And we don't know. I mean, we were talking the other day to potentially start, you know, further analyzing the opportunity, see how long we've gone, which is really not that long, and how far we can, you know, we want to keep the property before actually looking to refi or just straight up sell. The plan is to do a refi and then go onto long-term debt. That's the actual plan, but we want to have that flexibility. I mean, the market's still good. Hopefully it's still going to be good for the next year, at least year and a half. We're still going to have a strong market. So it might make sense to actually sell the property altogether and reap the all benefits.
Yeah, that's great. Well, that sounds like a great deal. Thank you for going into some detail on it. I appreciate that. Yeah. We got to start winding down, and I want to be respectful of your time. But I do have a final few questions for you. I want to get your knee-jerk gut reaction to them. You ready?
Okay, let's do it.
Okay. What's the biggest mistake you've made on your apartment investing journey so far that we could learn from?
Believing the old saying that if you build it, they will come, which in our industry and what we do, it's more like if you have a good deal, the money will come. I believe that at the beginning, and that's not, in my experience, honestly, that's just not true. You need to put in the work. You need to have all those relationships. You need to have a good investor network if you want to go out and pursue deals or partner with anyone. I have a lot of experience with potential partners that we already have actually in our deals in Jacksonville and other deals. People think it's easy to raise capital and do all that going into the deal, and it's not. So just finding a good deal, it's not the only thing. So I would say the lesson learned, it's yes, finding good deals is a very, very important skill, but raising capital should be a priority as well.
That's great. Thanks. What's the biggest win you've had so far on your apartment investing journey?
The first deal, I would say, the first multifamily deal that we did as a limited partner. I think that was game changer for us because the numbers were amazing. We had like, what was it, like 25% IRR and like 22% cash on cash returns. Like the numbers were amazing. So that's obviously good. But the lessons, the lessons learned, the fact that we took action, that we did our first deal, that I started actually using that deal as a track record as well. It allowed me to understand the business a little bit more, and it was, I would probably say that one. It was 296 unit deal in Dallas. So.
Oh wow! Okay, great. And then the last question I have for you is, what's the best advice you have for someone who's just starting their apartment investing journey?
Okay, that's a good question. Let's see. Someone that's just getting started, I would say take action, but that's not as fun. People always say that. It's very important. It's very important to take action, but I would have to say, pay attention to the relationships at the personal level. Honestly, and I think I mentioned this at the beginning, right? It's very easy to do due diligence if you have like a checklist of things that you need to do. Check the track record, check the way the operator or whoever, if it's a partner or whatever, the way they see the investment strategy, right? Like, okay, is it a good fit for you? Capital preservation versus like a little bit more risky, blah, blah, blah. You can, that's very easy to do. I mean, probably not easy, but it's simple, right? It's very straightforward, but it's not as simple. It's finding a good fit at the personal level, because as a limited partner first, it's very important to me that I'm actually passive in the deal. I don't care about seeing, reports every week or having a call being active, because that's not the reason I'm investing. I want to be passive, right? So I want to be 100% comfortable. I want to ask all the questions. I want to be very, very comfortable with the person or the company that I'm investing with, and understand are they going to do what they're going to do when things are wrong. If I believe that, if they ended up not being that way, well, okay, you had to learn from that. But the feeling that you have at the personal level, to me, it's very, very important.
That's great. Thank you for that. All right. Well, Lennon, man, I appreciate you taking some time walking us through your story and your journey into the space. I think you have a great story about how you helped your family transition their single family and condo rental portfolio. You started to learn all you could about this multifamily space and this concept of syndication. You dove in and you made that transition personally first, and how you're taking steps to really give back to others in the same way and helping them understand the benefits of investing in multifamily, especially syndications, and the option to be a passive investor in larger commercial syndications. And thank you for walking us through this 138 unit. Looks like a good deal for you, and I'm excited to see how it plays out for you in the future. And I just appreciate you taking the time and being willing to share all the experience that you have. So thank you for coming on.
No, thank you for having me, man. Thank you. Honestly, it's been my pleasure, and I want to acknowledge you because you actually, you do a great job at the interviews, first of all, and then your platform, it's fun. I follow you on Instagram, and you're very active there, and I see like the way you pay attention to a lot of details, the design, the whole thing. It's very nice. So, it's always fun to see people doing exciting stuff and teaching lessons learned and all that good stuff about multifamily, because that's what we're passionate about. So
great. Well, hey, thanks for that. I do want to remind everybody to go and check out Lennon's free ebook at his website. There'll be a link to it in our show notes. So go check that out, pick it up, and check out his podcast, Se Habla Real Estate. If you speak Spanish or if you speak English, maybe you can pick something out, even if you're just English speaking. But
we do English episodes every now and then. I mean, we're in Miami, right? So it's more like Spanglish.
There you go. Well, Lennon, thank you for taking the time. I appreciate it. And I look forward to talking with you again soon.
Thank you, man.
Bye-bye.